So let's get to work here. Now, I've been telling you for months, probably longer than that the policies of the Federal Reserve and the United States government, in that the government is spending so much more money than they're taking in, and that the Federal Reserve has been printing billions, hundreds of billions of dollars every single month to finance the U.S. deficit, as well as support the bond market and keep interest rates low, that all this extra money in deficits was going to end in inflation, and that it was coming. Well, I'm here to tell you now that it is here. It is here. The beginnings of the inflation storm are here. And this is just the outer bands of it. Wait till we get closer to the eye of the storm here, because you're just seeing the beginning of inflation. Now, this week, the Consumer Price Index came out. I think it was Tuesday, and then Wednesday, the Producer Price Index come out. What's the difference? The Consumer Price Index is what you pay for finished goods, things that you and I would go to a store and buy. That's consumer prices. Producer prices is the companies that make those products, their costs for their raw materials and their commodities and everything else. Now, producer price inflation always ends in consumer price inflation, because most companies are not going to eat the increase in their costs. They're going to pass it on to the consumer to the extent that they possibly can. And that's why when you see producer prices go up, you know down the pike, consumer prices are going up. Right now, we have both happening at the same time. So the Consumer Price Index came out first, the first day, and it was 4 times higher than forecast. And that's saying something. So it came out 0.8% for the month. Prices went up 0.8% for the month. Now you times that by 12 months, you get an annualized rate of 9.6%. Now we've had official inflation about under 2% for years right now. Now we know the official inflation is bogus, that those numbers are not true, but still, it's relative. So now we see inflation be announced at 0.8% for April. You know it's higher, all right? Everything is underestimated there. They want to keep your cost of living adjustment on Social Security down, so they're not going to accurately report it. But this was a real stunner to the markets. And month over month, we're seeing it continue to go up. Now, if you look year over year, April of last year to April this year, consumer prices are up 4.2%. That's the highest since 2008. So we're talking about 21 years. 13 years. Energy prices are up 25%. Gasoline prices were up 50% over the last 12 months. And, rising energy prices is something we always look at, because rising energy prices filter through to almost everything. If it costs more for me to pay for the electric and pay for the gas and the fuel to produce my products, it's going to filter into the cost of the product. Used car and truck prices over the last year are up 21%. Now, at this time last year, I was telling you that used car prices were plummeting. Well, the opposite's true now. Why is that? People can't afford new cars. Who wants to pay $70,000, $60,000, $50,000 for a car these days? Who could afford to? So people are looking at used cars. For the first time ever, used car prices are averaging over $20,000. For the first time ever. If you look at home prices, all right, let's not even get started on that. In the CPI, rent is included. Now, rent has only been up 2.1% over the last year. So rent hasn't gone up a lot. But if you substitute home prices for rent in the CPI, you'd have over an 8% year over year inflation rate. Now, the Federal Reserve is calling this, the magic word out of the Federal Reserve and the Treasury is transitory. Inflation is transitory. It's not going to last. And the reason being is they say that it's because, at this time last year, everything was plummeting in deflation because of the COVID and the whole thing. So, yeah, if we compare year over year. But that doesn't explain why we're seeing month over month over month inflation, where we're seeing it go up month to month to month. 2% month over month in January, 0.4% in February, 0.6% in March, 0.8% in April. That's not transitory compared to last year. This is this year. So not only is monthly inflation going up, it's going up at a more rapid rate each month of this year to where we're at the highest in April. and we'll see what May brings. Now, people are saying, the CNBC and all the talking heads, all you hear is the word transitory. Like, don't worry about this at all. It's going to go away. It's not real. And I'm telling you, the mainstream media, they use the same exact words. They're in the pocket of the Fed. They don't want you to believe inflation is real. Because if inflation is real and is not transitory, which it's not, then interest rates are going to have to go up. And this economy and the entire financial system cannot handle rising rates of any measure. So the Fed's going to jawbone the fact that inflation isn't real, it's only transitory. And the reason why inflation is going up is because the economy is booming. But that's not the reason why inflation is going up. The reason inflation is going up is because the Federal Reserve is creating out of thin air $120 billion a month. And they're doing that to keep the Fed funds rate at zero. They want interest rates low. So what they do is they buy U.S. bonds, whether they're mortgage bonds or whether, and that's what's keeping mortgage rates down and keeping the housing bubble going, is them buying mortgage bonds. Because if they're not buying the mortgage bonds, the yields in the mortgage bonds go up and the yields on mortgages go up, the interest rate. And we can't have that. Rising interest rate in a world full of debt is just unacceptable because it implodes the entire system. And if the economy is doing so well, it's booming, why does the Federal Reserve have to maintain zero interest rates and print $120 billion a month? And you have Biden out there and all the Democrats falling over themselves trying to spend trillions and trillions and trillions on Green New Deals, the environment, infrastructure, direct payments to people, extended unemployment, which we'll talk about that later in the program. And last month, they were expecting over 1 million jobs to be created. 226 or 266 were created. Very big disappointment. And when you have fewer people creating goods and services but getting money through stimulus, that's inflationary. And there's no return on the investment. If you're just giving somebody who's unemployed money and they're not producing a good or service, that's capital that's not producing. It's capital that winds up being inflationary. And the Federal Reserve has embarked on an experiment, a financial experiment like we've never seen before. And it's been going on for a long time. Now there's three different kinds of inflation. There's something called cost push inflation. Cost push inflation is input costs. So producers, like the producer price index, the price of commodities and all that stuff, that takes to produce something. And we're seeing that now. Iron ore prices up over 100%. Copper prices at all-time highs. Corn prices at record highs. Why is that important? Corn goes into everything, including gasoline, by the way, and ethanol. Corn syrup goes into every food. So just say, don't eat corn, so it's not going to affect me in inflation. No, yes, it will, because in almost everything you buy, look at it, you'll see corn syrup in it. So when producers have higher costs, they have to pass it along. So the day after the CPI came out, the producer price came out. And the producer prices were even worse than the consumer prices, showing a 0.9% up and 6.2% from April 2020, the largest jump since the index started in 2010. So we've had the biggest jump in producer prices on record. And as I said earlier, that flows through to consumer prices. The second kind of inflation, you have cost push inflation, which is the producer cost, and they'll push those costs over to the consumer. That's why they call it cost push inflation. The second type of inflation is demand push inflation. That's when people are spending a lot of money and they're chasing too few goods. They have too much money in their pockets. They have too much money coming in and they don't want that cash earning nothing, so they go out and buy things. And that's one of the reasons why you're seeing lumber costs go up and everything else. People are buying things, they're building things. So that's demand push inflation. Too much dollars chasing too few goods pushes the price up. Demand pushes the price up. Typical economics 101, supply and demand. When demand outstrips the supply, the prices go up. And there's a third type of inflation that we're starting to see right now, and that's wage inflation. What happens is the people say, I'm not making enough money to live here, so take this job and shove it. So companies have to raise their salaries to keep them happy. And we're seeing it now all over the place. Desperate for workers, U.S. restaurants and stores raise pay. McDonald's, Chipotle are some of the latest companies to follow Amazon, Walmart, and Costco in boosting wages, in some cases to $15 an hour or higher. So this $15 an hour minimum wage that the Democrats have been pushing forever doesn't have to even be passed because companies are doing it themselves just to retain workers or to get workers. And now what we have is states are opening up, people are coming back to restaurants and everything else, but the restaurants can't get the help because people are making more on unemployment. I can't blame anybody. You're going to give me more money to sit home on my couch than go to work. I'm going to sit on my couch. As wrong as that may seem, it's human nature. If you can get something for free and not have to work for it, you're going to do it. And that's what's wrong with this policy of all this extra unemployment, of all the stimulus payments. People who don't need the stimulus payments are getting the stimulus payments. I can't tell you how many of my tax clients come in and say, Lou, I feel guilty taking this. I don't need it. I didn't lose my job, or I'm retired, I'm still getting my Social Security and my pension. COVID hasn't affected me financially. But everybody got it. And all that money out there, think about it, the 3 different stimulus payments are still being paid to people who didn't get them yet. That money goes into the economy. Or it's supposed to. Well, that's what it's supposed to do. Some of that money is being used to pay off credit card debt and other debts or saving it. But a lot of people, just don't want to go to work. McDonald's on Thursday said it will raise pay for workers in its 650 company-owned stores to an average of $15 an hour by 2024. Entry-level employees will make $11 an hour. And the company is urging its 14,000 franchised restaurants to make the same changes. On Thursday, Amazon said it will pay new hires $17 an hour as it seeks to add 75,000 new workers. They're also offering a $100 bonus for new hires who have been vaccinated. Okay, so if you're a vaccinated new employee, we'll give you $100. More on coercion and bribery to get people to get the shot, which we'll talk about a little later on. But this is all inflationary. That's wage inflation. Why is that inflationary? You give people more money per hour, that's more money that's going to spend in the economy. You see how that's the velocity of money we've talked about in the past. And right now we have all 3 going on at the same time. We have cost push inflation, as producer prices are skyrocketing on everything. We have demand push inflation, as money's flowing through the system into the economy. And now we have wage inflation, as companies are going to have to raise people's wages as inflation gets worse and worse and worse. And again, we're at the beginning of this storm. And at the same time, we have money creation. Inflation starts from the money supply. It's always the money supply. The definition of inflation is inflating the money supply. And the M1 money supply, if I showed you a chart, I've talked about it, it quadrupled last year from $4 trillion to almost $5 trillion. Straight up. If you looked at it, you say, oh my God, you could see decades of slowly going up and then just spiking to the moon. I saw, my blood ran cold, being the economic geek that I am, and when I saw that chart, because I know what it means. I'm looking at hyperinflation. When you inflate the money supply, it dilutes the value of all the existing dollars that are out there. Very simple. Because the U.S. economy is only worth so much, the GDP. So if you keep creating money It dilutes the value of each dollar because the value of a dollar is based on the GDP. So you could increase the money supply when if the GDP is growing at 5%, you can increase the money supply by 5%. But last year you would need the economy to grow 450% the GDP to warrant the expansion of the money supply by 400 to 500%. And when you increase the money supply more than the economy grows, that creates inflation. It's textbook. It's textbook. And again, we're only at the beginning of it. So every month the Fed is monetizing the U.S. debt because we're going to have a $3 trillion deficit this year, maybe 3 to 4, depending on what gets through Congress as far as these stimulus, more stimulus, infrastructure bill, and all this kind of stuff. Maybe it's 5 trillion, 6 trillion, I don't know. Nobody wants to buy our treasury bonds. I mean, the Federal Reserve is artificially keeping rates so low. Let's look at the 10-year treasury note. 10-year treasury note is the benchmark. All right, we're back. The 10-year is used for everything. That's the benchmark. All yields, most yields on everything from mortgages to credit cards to car loans to government debt, paying it, the interest itself goes up based on what the 10-year does. So the Federal Reserve is doing everything it can to keep yields lower. How do they do that? They do that by buying debt. If they weren't buying debt to the tune of $120 billion a month, interest rates would be skyrocketing because people would be selling off bonds. There'd be nobody to buy our bonds. Who wants to buy the bonds of a country that's so indebted and continues to go in debt and there's no end in sight? There's no way the Federal Reserve has any of the tools necessary to fight inflation, to fight a declining dollar. As a matter of fact, they're exacerbating both by their actions. The U.S. government and politicians who don't seem to care or don't seem to understand basic economics and will spend money we don't have to the moon, and a willing Federal Reserve that'll monetize the deficit by printing money and buying our bonds. Now, the Fed is precluded from buying our bonds at auction. So they do a quick two-step. They buy it from the Wall Street firms that bought the auction 2 days ago. It's a pre-arrangement. Wall Street makes a risk-free profit on every transaction. Think about this, $120 billion a month. A month. A billion's 1,000 millions. So $120,000 million are created every month, and the Fed buys our bonds with it. Does anybody see a problem with this? You don't have to be a PhD in economics to understand the basics of this. What if Apple every month printed 120 million shares of stock? What would happen to the value of each share? They'd go down, right? Because they'd be diluting the existing shares. And that's exactly what happens to currencies when it's monetized, when it's created out of thin air. And monetizing a country's debt where the central bank buys the debt to fund the deficit always ends the same way, or at least historically did. If it doesn't happen this time, it'll be the first time in human history that it doesn't end through a currency crisis and inflation or hyperinflation. And the Fed can't stop printing now, because if they stop printing now, that means they're going to stop buying bonds. If they stop buying bonds, interest rates start going up in the bond market as the bond market sells off. Interest on everything goes up, including mortgages, cars, margin debt, government debt, local debt. And in the country, the whole world actually has never been more in debt than it is now. It's a debt time bomb. And rising interest rates is the fuse. Once that's lit, the whole thing comes down. But the Fed can't stop printing. And they'll come out and they'll still jawbone, they'll talk about transitory inflation. I mean, a couple of weeks ago, Bank of America came out, not just some tinfoil hat guy on the radio, came out and said that we're going to have transitory hyperinflation. There's that word transitory again. Some of the headlines that we saw this past week or two. U.S. core consumer prices explode higher at fastest pace since 1981. That's 40 years. A stunned Wall Street responds to today's scorching inflation print. The market was down when this CPI came out that day, 670 points, something like that. The Dow, one of the worst days we've seen in a long time in the market. Thursday and Friday it rebounded as more and more financial channels brought on Fed officials, and that word transitory. Don't worry about the inflation, it's going to go away. Another headline, the biggest rise in consumer prices in more than a decade is understated by half. And it's understated by half because the government doesn't report inflation correctly. Stagflation scare sparks carnage in cryptocurrency, stocks, and bonds. Home prices soar most on record as Fed continues bubble-blowing policies. How about this one? The United States spends 90% more than it collects in first 7 months of fiscal 2021. That's amazing. We've spent 90% more than we've taken in so far this year. By the way, the fiscal year starts October 1st for the United States. So it's October 1st, October 1st. So we're about 7 months into fiscal year 2021. Let's look at home prices. The home prices have gone up more over the last year than I think they have in history. The national median existing home sales price rose 16.2% on a year-over-year basis to $319,200, a record high since 1989. All regions recorded double-digit year-over-year price growth, with the Northeast seeing 22.1% increase, the highest of the Midwest is the lowest at 14.4%. Now, this is great if you own a home. And a home is inflation protection. How do you protect yourself against inflation? You own real things. Money in the bank is not protected against inflation. It's vulnerable to it. But a home will go up in value. As the dollar loses value, it takes more dollars to buy the same thing. And it's not that your home's going up in value. The dollar's going down in value. You got to always understand that. Nothing goes up in value because of inflation. It's the currency going down, where it takes more of that currency to buy the same thing at the same value. And the old saying goes, in 1935, an ounce of gold would buy a fine man's suit. And today, an ounce of gold will buy a fine man's suit. Has the fine man's suit changed? No. It's still a suit, and it provides the same value than it did now than it did then. So now a fine man's suit at $1,800 is the same as a fine man's suit at $35 way back when. Did the suit go up in value? No. The dollar went down in value. And we're seeing that with real assets right now, which is great if you own a home. Like I said, if you own a home, you have inflation protection, at least in that area of your life. I bought my house 6 years ago. I paid $329 for it. And I hadn't followed the price of my home because I'm not selling it. I'm not, it's not important to me right now. But in my monthly retirement newspaper, on the back, there's a real estate agent that always has local houses for sale that she has sold recently. Half the page is sold and the other half is still for sale. I saw my exact model of my home sold at $479,000 in my own neighborhood, the same model. And I know in my home, since I've been there, I put tons of money into it. New heating and ventilation, air conditioning system, new fireplace. I forgot half of what I've done. I've done a lot of stuff in here. So I think it maybe it's worth $500,000. And that may be cheap compared to next year. And you've heard the stories that, as soon as a house is listed, there's bids on it, and most times above the asking price. And sometimes way above the asking price. Some people are buying houses without even seeing them. They call a real estate agent and say, just bid on. Now, if you're looking to buy a home, this is a real problem. because affordability is becoming a big problem right now. Forget low interest rates, who cares? You got to borrow more money or have a bigger down payment. 20% of $500,000 is a lot different than 20% of $300,000 if you're putting a down payment down. And if you don't put the 20% down, then you have to pay private mortgage insurance on top of the mortgage itself and the real estate taxes. So first-time home buyers are being priced out of the market. That's inflation. And hyperinflation is an extreme case of monetary devaluation. It happens so fast. I think it was Hemingway who once said, we're talking about him going broke. He said it started slowly, and it happened overnight. All of a sudden it just accelerated what was going on in his financial life, and boom, it was gone. Now, hyperinflation, there's a loose definition of it. A loose definition is prices going up 50% in a month. Imagine that, 50% in a month. Well, that's nothing compared to the major hyperinflations in the last 100 years. Most notably Germany, it's the best example of hyperinflation. I've gone through the whole story of Germany during the Weimar Republic. It was right after World War I. Germany was forced to pay the Bank for International Settlements reparations to go to France and Belgium and the countries they destroyed. And to meet those obligations, they couldn't use their own currency. They had to get foreign currency. So what they would do is print Reichmarks and buy US dollars or buy British pounds or whatever and make those payments. But by doing so, the value of their currency dropped so quickly, it took more and more and more to get that foreign currency because nobody wanted it. And at the worst, the height of the hyperinflation in Germany, inflation rates were more than 30,000 a month. Boy, that 50% a month sounds pretty good, doesn't it? When you're looking at 30,000 per month. Prices doubled every few days. And you've seen the photos of people walking around with barrels of money, or they put it in their fireplace to warm themselves up because that's all it was worth. More recently was Zimbabwe. Its inflation spiraled out of control between 2007 and 2009. Their hyperinflation was a result of the political changes in the country. There was seizure and redistribution of agricultural land, and there was a drought, and it was mismanaged. Their hyperinflation at its peak exceeded 489 billion %. Wow, right? That makes Germany's inflation at 30,000% pretty good. No, that's not what I would do. My extra $2,000 a month would go into silver coins. Yeah, silver and gold. Yeah, that's always been the inflation protection. The rich have always done that. In Germany, the value of an ounce of gold in 1919, just before the hyperinflation started, was about 187 Reichmarks. A year later, it was over 3,000 Reichmarks. A year later, it was 300 and something thousand Reichmarks. And at the end of the inflation in 2023, it was 87 trillion Reichmarks for 1 ounce of gold. The Reichmark disappeared in value. It was no longer had any value whatsoever. But the people who had gold and silver protected their wealth because it went up. They didn't have to turn it into Reichmarks. They could turn it into Swiss francs or US dollars or British pounds. And that's the good thing about metals is that they're universal money. You never ever have to convert it back into your currency. But if you do, say you have inflation of 100% and your gold goes up 100% or your silver goes up 100%, you didn't make any money, but you preserved your purchasing power because you can go out and buy that loaf of bread that's 100% higher because you have twice the amount of money. All right? So, you don't get wealthy with metals, you protect the wealth that you have. Let's go to Hungary, which was the worst. When I was doing research on this, a few months back, I don't know, JB, if you were here at the time, I spent a long time talking about the inflations of the last 100 years. And I was surprised to find out it was Hungary after World War II Now you think the German 30,000 a month was bad. You think the Zimbabwe 489%, 489 billion percent was a lot. Economists estimate that the inflation rate in Hungary reached 41.9 quadrillion percent per month. Quadrillion. A quadrillion is 1,000 trillion. So this is almost 42,000 trillion percent rate. I mean, it's like every minute prices are doubling. Now, during this period, prices in Hungary doubled every 15 hours. By August of 1946, the total value of all Hungarian banknotes in circulation, all of it, the value of it all, was less than 1/10 of a penny, a United States penny. All the currency in Hungary. Now, can that happen here? You're damn right it can. Do I think it's going to happen? Probably not. I pray not. You know, I mean, God, you know. I mean, we're living in crazy times right now. Can you imagine living in a hyperinflationary environment on top of that? Yeah, no way is right. But inflation is here. Inflation is real. We all have to come to grips with it. One of the best investments you can make these days is food, because food prices are going through the roof. I was in a grocery store yesterday. I talk about this a lot. I just went in to get a few things. It was $106 by the time I was done. Now, you know, I got a few more things than I expected, but it was like, it was 4 bags. It wasn't, and you know, I'm not buying filet mignons and stuff like that. I mean, it was produce and stuff like that. But, you know, everybody knows it. I came in today, you know, on the Parkway. Regular gasoline, $3.15. Right? It wasn't long ago, it was $2.20. Yeah. That was PB, pre-Biden. $2.22. And now look at it. At $3.15. Now, with the shutdown of the pipeline, and that's a scary thing, maybe we'll get to it later in the program, that foreigners could hack our infrastructure. Look what it did. You know, just shutting down a pipeline a week, less than a week. Look at what happened in states like Florida, Georgia, South Carolina, Virginia, North Carolina. I mean, first of all, a lot of it had to do with panic buying. You know, people, they weren't out of gasoline yet, but people were afraid that they weren't going to be able to get it. So they panic bought and drained everything. But look how easy it is to shut down something so precious as the fuel of the East Coast. That's scary stuff. What about the electric grid? Can they just shut down half the country's electric? Pretty scary stuff. Another problem with inflation we're having now is supply lines are stretched because of COVID and crazy lockdowns we had. Shipping prices are going through the roof. That's inflationary, the cost to ship things. We have a shortage of truck drivers in the country, especially those who transport gasoline, because you have to have a certain license for that. Last year, many of them retired because of COVID and everything. So now we don't have enough people driving tankers. And with the demand going up this summer as the lockdowns end and people start going back to doing normal stuff, the demand for gasoline is going to go higher. We're going to see much higher gas prices in this country, while the administration policy is to shut down pipelines, to shut down production, to shut down leases, to shut down fracking. Inflation, energy inflation, and food inflation are going to be the main drivers of this. So, you know, you see a can sale at ShopRite, get as many as you could afford, because I guarantee it's going to be much, much higher, you know, in the months ahead. So inflation is here to stay. It's going to be a big story. We were ahead of that for the last year or two, and it wasn't a bold prediction because it's just economics 101. You go in debt, you have deficits, you print money, you have inflation, and you have currency decline. And that's where we are in America right now. All right, 732-505-1160 is the call number. My name is Lou Scatigna. Don't you go away.